Welcome to a short video on accounting for agricultural activity. AASB 141 deals with two types of assets: biological assets and agricultural produce when they relate to agricultural activity. Agricultural activity is the management by an entity of the biological transformation and harvest of biological assets for sale or for conversion into agricultural produce or into additional biological assets. Biological assets and agricultural produce will both be defined shortly. There are two key issues in relation to the accounting for agricultural activity. These are 1. How to deal with assets which are growing and changing. Biological assets are unique to the extent that they are living things which are able to change on their own accord. And 2. How to allocate costs between these different assets. We've generally seen asset standards require that all costs attributable to getting that asset ready for use included as part of the cost of the asset. However, with agricultural activities, it's not uncommon for biological assets to remain alive once the agricultural produce has been harvested. As such, should the cost of growing the sheep be included as part of the cost of the biological asset, or as part of the agricultural produce, or split between the two somehow? AASB 141 Agriculture solves this problem by using a fair value system for these assets. This means that fair values are used rather than historic cost, and all changes go to profit and loss. Turning first to biological assets. According to AASB 141 paragraph 5, biological assets are living plants or animals. According to paragraph 12, these are to be measured initially at fair value less cost to sell, and then at each reporting date at fair value less cost to sell. All gains and losses, either from initial recognition or year-to-year changes, are to go through the profit and loss statement. Now turning to agricultural produce. According to AASB 141 paragraph 5, agricultural produce is the harvested produce of the entity's biological assets. According to paragraph 13, these are to be initially measured at fair value less cost to sell. Once they have been recognized initially, they are to be treated as inventory under AASB 102. Any gain or loss from initial recognition is to be recognized in the profit and loss statement. So, as mentioned previously, as AASB 141 is a fair value standard, it doesn't matter where costs are allocated, as A, the balance sheet will look the same because both the biological assets and agricultural produce are recognized at fair value, and B, the profit of the company will be the same regardless of whether these costs are capitalized or expensed. For the following example, we have grapevines with a fair value less cost to sell of $150,000 at the start of the year, and a fair value less cost to sell of $155,000 at the end of the year. The other information we have is that grapes with a fair value less cost to sell of $76,000 were harvested during the year, $12,000 was spent on fertilizer, and $10,000 was spent on costs associated with picking the grapes. The question is, how do we account for all of these things? Now, I'll be explaining this with T accounts rather than completing the journal entries. Because AASB 141 is a fair value system, we can do whatever we want with the fertilizer and harvest costs, and we'll still get the same answer at the end. In this first example, we've decided to expense all the costs. So we debit $12,000 and debit $10,000 to a generic expense account. The vines start at $150,000 and end at $155,000. This difference means the vines are debited $5,000 and a gain is credited of $5,000. Inventory began with $0 because there was no inventory, but ended up with $76,000. This means we debit inventory $76,000 and credit gain $76,000. Taken together, the fair value gain for grapevines and inventory is taken to the profit or loss statement, and so too is the $22,000 of expenses. This means we end up with a profit of $59,000 in total. In the second example, we've decided to capitalize all the costs against the grapevines, so we debit $12,000 and debit $10,000 to the grapevine account. This means grapevines have a carrying value of $172,000. However, we know the carrying value is only $155,000 at the end of the year, so we credit grapevines $17,000. This means loss is debited $17,000. Inventory began with $0 because there was no inventory, but ended with $76,000. This means we debit inventory $76,000 and credit gain $76,000. And nothing happens to the expense account. Taken together, the fair value loss for grapevines and the initial recognition gain for inventory are taken to profit or loss. This means we again end up with a profit of $59,000. In the last example, we've decided to capitalize all the costs against the grapes, not the grapevines. So we debit $12,000 and debit $10,000 to the grapes account. This means grapes have a carrying value of $22,000. However, as they are initially recognized at $76,000, we need to debit an additional $54,000 to grapes and also credit gain $54,000. The grapevines account has increased by $5,000, which is debited, along with a credit to gain of $5,000. And nothing happens to the expense account. Taken together, the fair value gains for grapevines and inventory are taken to profit or loss, and this once again means we end up with a profit of $59,000. And that wraps up accounting for agricultural activity. The key takeaway points are: 1. AASB 141 is a fair value standard. 2. For biological assets, initial recognition is at fair value less cost to sell, with gains and losses going to profit and loss. Whilst at period end, the assets are again recognized at fair value, with any gains or losses going to profit and loss as well. 3. For agricultural produce, initial recognition is at fair value less cost to sell, with gains and losses going to profit and loss. But after that point, they are treated as inventory under AASB 102. And lastly, it doesn't matter where costs are allocated, because ultimately you will get the same balance sheet and profit and loss statement. I hope that helps. If you have any comments, questions, or feedback, you can either leave them here on this video or tweet me at Dr. Dave Bond.